you know, yesterday was the biggest sell-off of the year, right? Yep. 767 points down on the Dow. I just was reading an article, brace for a second wave in the stock market volatility, and this one could be Lehman-like, says Nomura. Sell in preparation for the second wave of volatility expected in late August or early September. What do you think of that?
Well, I'm not sure what to make of it, quite frankly. That's a very
so scary with the
headline. It's a grandiose headline. I mean, look, I think that seasonally speaking, August, September are typically amongst the most volatile months for equities anyway. So to make that statement about late August, I mean, nobody has a crystal ball. Look, what is happening right now is actually very rational and very good. 2 weeks ago, most people expected a resolution to the trade war by the end of the third quarter, end of summer, early fall. That's off the table. It's very clear that we're not going to have a resolution very quickly. And so markets are recalibrating for that. If you think about the fact that the Fed and other central banks around the world are easing monetary policy to help support that, but you've got the counterweight of the trade war and some of the nationalism going on around the world, that makes stocks fairly priced around here. And so to us, that doesn't mean panic, but it does mean that you want to be very selective in terms of which investments you select going forward.
I think that there's just, something that's very clear. Either you use the pullbacks to pick some great companies that you like.
If you have cash.
If you have cash or you want to move your money around a little bit. Or, like Nomura is saying here, use any bump, like a day like today, to just sell. I mean, would you be that person, or would you be more likely
I think what you want to do is you want to take a look at your portfolio and kind of strengthen it and ratchet up the conservatism in there. In other words, sell higher beta, more volatile names that you maybe have big profits in, and take a look at some of the underperforming stocks that may have a stronger dividend and a good balance sheet. Consumer staple stocks have underperformed. Healthcare stocks have underperformed. And you can get a 3.5% to 4.5% dividend with a rock-solid balance sheet in some of those names. And that's what you want to focus on in a less secure environment.
Yeah, and some of those dividend-paying stocks are doing great. And I want to get to your thought on bonds, but I know you have some great stock picks, including ICE, Intercontinental Exchange, the parent of the New York Stock Exchange, clearing, trading. You think great management?
Yeah, I mean, they're executing on all cylinders. One of the things that we look for in a slowing growth environment, globally speaking, is companies that are still growing, are taking market share away from their competitors, and are improving margins. ICE, Intercontinental Exchange, falls into that mantra. They're just executing on all fronts. They went through a number of years of underperformance, but they've really turned things around, not just here in the U.S., but globally. And the global picture is what really matters with them.
Right. And then Intuitive Surgical and Microsoft.
Yes. So Microsoft, Nadella has really unlocked the potential for Microsoft. We think it's a terrific company. They're executing on all cylinders. They're gaining just about everywhere they need to be. And so, it's a great company with, solid management. And there's nothing that lies ahead that makes us think that that is going to change anytime soon. Intuitive Surgical, again, same type of growth story, except that they're 10, 15 years ahead from their competitors in terms of robotics-driven surgeries, right? I mean, the name says it all. And again, so you want to look for companies that are just killing it in their category. That's what's important, because when there's an absence of growth, investors will be willing to pay up for growth.
I just saw the chart. Intuitive Surgical pulled back a little bit recently. Is this a good point to get in?
In our view, yes. We're long-term buyers. None of the names that we invest in are something that we trade or are concerned about 1 or 2 or 3 quarters worth of earnings. It's more about the fundamental strength of the business and do they continue to execute. You miss by a penny or two here or there, that can slam the stock down, but it doesn't mean that there's anything fundamentally wrong with the company. And so on a long-term basis, we continue to hold and buy.
Right. So you mentioned Microsoft, Intuitive Surgical, Intercontinental. A quick thought on Disney. So I think you like that one as well. We're doing a whole discussion on the back half of the show.
Disney's coming out with earnings this afternoon after the bell. It's, again, a great name that we love and that we own. Again, talk about a company that is just dominating in every vertical in which they're in. I mean, they have the largest movie studio in the world. They have the theme parks that are doing exceptionally well. They've got the biggest content library out there.
I believe you. I believe you. Okay, let's get to just your asset allocation. I noticed that your numbers for cash came down a little bit from December. This volatility, does it spook you that you want to change the position in cash, maybe add more cash?
So
or
our
what?
cash holdings are generally driven by our sell discipline. We think it's incredibly important for investors to have a sell discipline. If a story changes with a company, if it hits its price target, you should be willing to take chips off the table. And that's what drives our cash holdings, as opposed to a global macro view that says, oh, we want to have 5% versus 7.5%. We're just a little bit more bottoms up there.
Right. I see neutral weight on U.S. large cap equities, overweight some European equities. The one thing that I thought was interesting here, overweight fixed income. You know, there's some thought here that it's overbought. Right, you've been seeing the price running up.
That's been the thought the last decade.
Yeah, and you've seen the yields coming down. I mean, there's some people who are really worried about how far those yields.
I mean, we own short.
You're not worried?
Not at all. We own
Short-term.
short-term, high-quality corporate and treasuries. And that's really more to mitigate volatility in the overall portfolio, because we are seeing volatility pick up in equities, and so you want to kind of offset that. And the best way to do that is to have treasuries and high-grade corporate bonds in the short end, meaning less than 2 years in maturities. So we're not worried about short-term volatility or what happens with yields over that time.
All right. Over those four names that we mentioned, is one the standout out of the four names that you picked?
Well, I guess I'll make our chief compliance officer happy by saying it's part of a well-diversified portfolio.
Okay.
But if I were to pick a single name out of those four, I would say Intuitive Surgical at this level is probably.
It's a great one.